Okay. So today I thought of discussing a very important chapter in the syllabus, which is property, plant and equipment, Lkas 16, right? So if you take the exam paper, in many areas, you will be checked this property, plant and equipment adjustment, okay? Especially in the company final accounts, sole proprietorship, manufacturing accounts, like partnership, right? So all the main questions and also in cash flow statements, you will be checked this standard. So this is a very important chapter. So I will be covering the entire part which is relevant for the A-level syllabus today before end of the session. Okay, right. So there are some definitions in the standard. Okay, number one is depreciation. So what is meant by depreciation? Depreciation means it is the allocation of depreciable amount of an asset over its estimated useful life. That is called depreciation. Right? When we are buying an asset, when we are purchasing an asset, we don't consider that asset as an expense, right? So this is a way of distributing the expense along the useful lifetime. For an example, if you purchase a motor vehicle, right? If we purchase a motor vehicle, we don't consider that motor vehicle as an expense during the current financial year. Right? Let's say the motor vehicle value is 1 million. So that 1 million, we don't consider as expense during the current year, right? 1 million motor vehicle cost. What we do is, for accounting purpose, we divide this total cost along the useful lifetime. So let's say we are planning to use the motor vehicle for 4 years. Right? So 1 million divided by 4. Annually, our usage of the motor vehicle is 250,000. So this is called depreciation. There are different methods we can divide the total cost. There are different methods. So one simple method is get the total, divide by the useful lifetime, and annually you can allocate the same amount for the useful lifetime. So that is called depreciation. So what is depreciation? Let me repeat. It's allocation of the depreciable amount of an asset over its useful lifetime. Then the second definition is what is meant by a depreciable asset. A depreciable asset is an asset. Now, we don't depreciate all the assets, right? A company may buy, a business may buy different types of assets, but all the assets are not depreciable assets. So what are the depreciable assets? The depreciable assets are expected to be used more than one accounting period, and more than a year. We are planning to use the asset for more than 1 year and have a limited useful life. Now, if you take a land, we don't depreciate the land in our financial statement. Why? The reason is we don't have a limited useful lifetime. That is why we don't depreciate land. Okay. Then, held by an enterprise for use in the production, either we use in the production or to supply goods and services. To supply goods and services means for the delivery purpose, vehicles, mainly the vehicles, and for rental to others. If you take building and all, we rent to others. Okay, depreciable asset. Then the depreciable amount. That means how much will we depreciate? it is equals to the cost minus the residual value. Cost minus residual value is the depreciable amount. Right? Residual value means the scrap value. Okay. What we'll do is we will directly move to the questions part. Okay. In between, if you all have any doubts, you all can ask. Okay. Right. Okay. So we have Lkas 16. First, let's identify what is meant by the capital expenditure and a revenue expenditure. Then we learn the depreciation methods, the types of depreciations. Then the revaluation, what is meant by revaluation, and disposal part. Okay. So we'll start with let's start with capital and revenue expenditure. Okay. Now, when it comes to expenses, there are two types of expenses. Right? This is very important. One is capital, other one is revenue. All the expenses we can divide capital expenditure and revenue expenditure. Revenue expenditure means it is incurred for the purpose of trade or to maintain non-current assets. These are normally we consider as day-to-day expenses, right? So there are two purposes: incurred either for selling purposes or to maintain non-current assets, and this will be recorded in the statement of profit and loss, in the income statement. So we call it revenue expenses. The second type is capital expenditure. This is incurred for the acquisition of non-current asset or increase the capacity of non-current assets. So two purposes. One is acquiring or buying a non-current asset, purchasing a motor vehicle, purchasing a land, purchasing a building. Then the second one is capacity increase, increasing the capacity. Right? You have a building, you expand the building. Right? You have a motor vehicle, you renovate and add or renovate the engine. So the capacity, the efficiency increases. So that is called a capital expenditure. So these type of capital expenditures will be recorded or taken under statement of financial position. Okay. Then if you take income also same. Capital income, revenue income. Revenue income means our normal day-to-day sales and operational income. Capital income means the proceeds from sale of non-current assets. NCA means non-current assets. Non-current assets. Okay. Is it clear? Now let's do an example. So from the example, I will explain this. Right. Can you all do this example? Let's do it together. State whether each of the following item should be classified as capital or revenue expenditure or income for the purpose of preparing the statement of profit or loss in the statement of financial position. So there are few expenses. Right. The number one, the purchase of property. Okay, I'll give few minutes. Can you all try? there are 12 expenses. Let's see whether you all can do this. So until that, others, I'll repeat what is meant by capital expenditure and what is revenue expenditure. Okay. Capital expenditure means there are two main things. One is acquiring a non-current asset, acquiring a property, plant, or equipment. Property, plant means the land, building, motor vehicles, furniture, equipment, machineries, right? Acquisition. One thing. The second thing is increasing the capacity of the non-current assets, increasing the capacity, right? So once you incur that expense, the capacity or the efficiency of the non-current asset should increase. Then we can consider it as a capital expenditure. Now, let's say you have a land, right? Then you have a building in that land. So you expand the building, or maybe you can have a separate unit or a reception area. You are developing a reception area. So that will increase the capacity. Okay, let's say you are painting the building. If you paint the building, it doesn't increase the capacity. It is a revenue expenditure. Painting a building or maintenance, those are revenue, right? Try to do this. There are 12 questions. Try to do it. Then we'll see whether you are understood or not. There's a question. So what is meant by acquisition? Acquisition means purchasing, acquiring, purchasing a non-current asset. Acquisition. Acquisition and disposal. Disposal we will do later. Okay. Right. So first one, I'll just explain. The purchase of a property. Purchase of a property. Example, an office building. Purchasing an office building, right? So first one, it's very simple, capital expenditure. Second one is annual depreciation of such property. Depreciation is revenue expenditure. Depreciation is revenue expenditure. Okay. Depreciation is revenue expenditure. Right. Can you all tell me for the third one, solicitor's fee? Solicitor's fee means the legal fee. Legal fee in connection with purchase of such property. What is the answer? Is it a capital or revenue? Solicitor's fee, is it capital or revenue? It's not revenue, it's capital, because that cost is for acquiring the non-current asset. It is capital. Don't get confused. It's capital expenditure. It's not revenue, it's capital. Okay. Acquisition, that cost is related to acquisition of the property. Right. Now I'll just brief you on another thing. Say we are purchasing a machinery for our business. So that machine we are purchasing from China. That machine is in China. So you will pay the cost of the machine. You will pay the purchase price to the buyer in China. So that's system. Then you will have to pay transport cost from China to Colombo or China to Sri Lanka, the transportation. And there will be insurance, legal charges, right? Any other cost, taxes, custom. So all these costs will be capital expenditure, right? And also, let's say you took it to your company, your factory. Then you have an old machine, right? You have an old machine, you have to dismantle the old machine. So that cost, dismantling the old machine, that is also capital. Then you have a fixing cost, fixing charge. So that cost also capital, right? Until you fix that machine, all the cost related to the machine. After fixing the machine, let's say you have to put fuel and operational cost. That is revenue. Okay, so that's how you understand the difference between capital and revenue expenditure. Okay, right. Then next, the costs of adding extra storage capacity to mainframe computer used by the business. Extra storage capacity, additional capacity. So it will increase the capacity. It directly says it's capital expenditure. This is capital expenditure. Extra capacity, so it's capital. This is very important to understand. Okay. There is a question. So what is installation cost? Installation means installing. As I said, the machinery, you buy the machine and you install it in your factory. Installation cost. Repair is that cost. Computer repair and maintenance, simple. It's revenue. It's not capital, it's revenue. There is another one. Does building repair to fix a machine comes under capital or revenue? Building repair is revenue, right? Let's say you have a machine and you have to fix that machine. And to fix that machine, you do a basic work or basic installation cost. So that can be capitalized. That may be capital because without repairing that, you can't install the machine. So that cost will become capital. Okay. So Profit on the sale of an office building. So this is a capital income. This is a capital income. Sale of an office building. Revenue from sales by credit card. So that's a revenue income. Revenue income. That is capital. Right? So these are simple. Customs duty charged on the plant when imported into the country. So as I said, this is also related to capital expenditure. Okay. It's also capital. The carriage costs of transporting the new plant from the supplier's factory to the premises of the business purchasing the plant. That is also capital. Now you understand, right? Now it's easy for you to understand. The cost of installing the new plant in the premises of the business. That is also capital. Finally, the wages of the machinery operator. So I hope now it's clear what is capital and what is revenue. Okay, you can ask me any questions if you have. Okay, right. Let's move to the next part. Depreciation. Now, this is how I am doing. First, we understand capital and revenue expenditure. Then the second part is depreciation. So let's learn depreciation. Depreciation means it's allocation of depreciable amount over the useful life. Depreciable assets, depreciation amount. We will be using the first two methods in our exam. Okay. Straight line method and reducing balance method. Okay, so let's move to the types of depreciation. Right. Starting with straight line method. You will be checked only the first two methods. Okay. You will need to study the definitions. Definitions better to understand what is the meaning of each. There are only few. What is depreciation? Okay. So first, let's start with straight line method. Straight line method. Now I have a question for the straight line method. The financial year of Lata and company is from 1st of January to 31st December. 1st January to 31st December is the financial year. On 1st of June 2015, of which the cost and the residual value 200,000 and 20,000 respectively. It is indeed to be used for 3 years, intended to be used for 3 years. Right? So useful life is 3 years. Required, calculate the depreciation rate calculate the depreciation charges for the year ending 2015 December, 16 December, and 17 December. And also 18. 18 also will calculate. Okay. Can you all tell me how much is the depreciation rate? Depreciation rate means it is equals to annual depreciation over cost into 100%. Tell me how much is the depreciation rate? How do you find annual depreciation? Annual depreciation means cost minus residual value over useful life. Residual means the value. After using the asset, what is the value? What is the selling price? Residual value. After using for 3 years, for how much you are planning to sell this asset? First, you calculate the annual depreciation. Cost is 200,000, residual value is 20,000. So cost minus residual value. Divide by useful lifetime 3 years. So annual depreciation, you will get 60,000. 60,000. There is a question. So whether the residual value and the scrap value is same? Yes, both are same. Scrap value and the residual value is same. Annual depreciation is 60,000. Cost is 200,000. Into 100%. So what is the percentage? – 30%. Right. So that's very simple. Okay. Cost minus residual value divided by useful lifetime is the annual depreciation. Now let's calculate the depreciation for each financial year. So understanding this is important because in our exam papers, we won't get the first year. We will get sometimes in between. Depreciation, there might be a special question. So let's start with 2015. For the income statement, you will have depreciation. For the income statement, you will have depreciation. For SOFP, you need to show the cost and the accumulated depreciation. And be required. Right. So depreciation rate we calculate the depreciation using the rate. Okay. So in 2015, we will be using this. We will be using this machine only how many months? How many months we have to depreciate for 2015? Purchasing on 1st of June. So how many months will we have to depreciate? I got few answers, but all the answers are wrong. Wrong. How many months will you depreciate? This is where you make mistake in your exam. 6, 6, 6, 6, 6, 6. Only one. Yes. You have to look at dates properly. You have to look at the dates. Otherwise, you know how to do it. There are 7 months starting from 1st of June. June, July, August, September, October, November, December. So 7 months. You will depreciate 7 months. Seven months depreciation. 200,000 into 30%, 7 over 12. So it's 35,000. 35,000. Cost is 200,000 and depreciation is 35,000. Book value is 165,000. Okay. Then in 2016, how many months will you use the machine for 2016? What is the depreciation for 2016? What is the depreciation for 2016? You will use the machine for full year. Yes. So 12 months, 60,000. Depreciation is 95,000. Right. Then 2017. 2017 also we depreciate for 12 months. $155,000 accumulated depreciation. Then in 2018, tell me how much is the depreciation for 2018? What is the depreciation for 2018? Yes, correct. Okay, so how many months? We will 2 years and 7 months completed. 2 years and 7 months completed. So there will be another 5 months. Only another 5 months. So 2018, and the balance will be 200,000 minus 180 total depreciation. 20,000. This is your scrap value. And remember, in 2018, if you do, we don't depreciate for 2018. So 2019. This is a fully depreciated. This will become a fully depreciated asset in 2018. Okay. I hope you all understood this. We will move to the next question. Here the requirement is up to 17, but I wanted to show how do we calculate for 2018 as well. Okay, now let's move to the next question. We did straight line method. Now let's see how to do the reducing balance method. Reducing balance method. Okay, let's do for reducing balance method. Reducing balance method. The cost of an asset is 100,000. Depreciation rate is 25%. Calculate the depreciation, accumulated depreciation book value, and depreciation for the year goes to income statement. This is the statement of financial position. Cost is same, 100,000. Every year the cost is 100,000. Okay, can you all do this step? Depreciation will be 25%. So you have to calculate 25%. from the cost, from the initial cost. So it's 25,000. Then accumulated depreciation is 25,000. Book value is 75,000. Right. Then second year, you have to calculate for the book value for the second year. So this amount we have to calculate 25%. 25% for 7,750. 18,750. Then the total accumulated depreciation is 43,750 and book value is 56,250. Can you all complete the rest? Right. Third year, it will be 56,250 into 25%. So total will be 43 plus 1463, 57,830. Fifth year, fourth year, it's 10,547. And this is C3, and you can complete the rest. Finally, you will have 23,730 as the book value. Okay, so this is reducing balance method. Okay, we will do everything from the base. You understand the PPE related stuff. Okay, so let's move to the next question. The next point is change in method of depreciation. This is also important because sometimes in our exam paper, there are questions where the depreciation method changes, and from reducing balance method to the straight line method, or straight line method to reducing balance method. Changing the depreciation method. Then how do we adjust it in the financial statements if the depreciation is changed? Okay, so let's do this question to understand the change of depreciation method. Right. Giant Co purchased an asset for 10 million on 1st of January 2001. It had an estimated useful life of 5 years, and it was depreciated using the reducing balance method at a rate of 40%. On 1st of January 2003, it was decided to change the method to straight line. Show the depreciation charge for each year of this asset's life. 5 years. Depreciation is 5 years. Can you all do this? I'll give 3 minutes. I'll give 3 minutes. Initially, the asset cost is 10 million. I'm doing in thousands. Okay, so 10 million. First, they depreciate 40%. 40% depreciation. From this, they depreciate 40%. 4,000. So that's a depreciation. Then the book value is 10,000 minus 6,000. Can you all complete this? What happens when change the depreciation? 1st of January 2013. After 2022, they are changing the depreciation. There is a question, what is SOCI? That is Statement of Comprehensive Income. This is income statement. Income statement. This is balance sheet. Okay, 2002. First year one is simply you can calculate 40%. Year two, we calculate 40% from book value. Then 6,000 into 40%. Year two. From this value only we calculate 2,400. Then cost is same. This is 4,000 plus 2,400. 4,000 plus 2,400. Then 6,400. And let's calculate book value. 3,600 is the book value. End of 2002. First of January 2003, it was decided to change the method to straight line. So here, at the beginning itself, they are changing the depreciation method. Changing the depreciation method from reducing balance method to straight line method. Now, if you are changing the depreciation method from reducing balance method to straight line method, in straight line method, depreciation will be calculated by taking depreciable amount over remaining useful lifetime. So you will have to calculate the depreciation by taking depreciable amount, or we can say remaining depreciable amount over the remaining useful life. Can you calculate the depreciation for third year? This amount. What is this value? Tell me the value. What is this value? Now the remaining depreciable amount is 3,600. Remaining depreciable amount is 3,600. Divide by remaining life is 3 years. So depreciation 3,600 divided by 3,200. 2,400 is the book value. 36 plus 1,200 is 7,600. So 6,400 plus 1,200 is 7,600. Then the remaining book value is 2,400. There is no residual value, no scrap value. Therefore, it's very simple. Remaining amount divided by lifetime. There is a question. If they change the method on the last day, then what will happen? If they change the method 2013 December 31st, then 2013 also reducing balance method. 2014 only you have to do the straight line method. Last day. This is first day, no? So you have to follow this method. Then remaining 2 years also you can do same method, that divide by 3 1,200. Straight line method, no. So every year depreciation is same. Okay, so 2004 cost is same. Accumulator is 7,600 plus 1,200. These two, 8,800. In 2005, fully depreciated, 10,000, 10,000. There is no book value because no residual value. Right. Uh, okay. So let's move to the next point. Now we did the depreciation basics, types of depreciation, and changing depreciation from straight line, reducing balance to straight line change. Next, I'm going to do depreciation of assets acquired partway through the year. So when we purchase the asset in between the year, right? We are purchasing on 1st of July. We are purchasing on 30th of September. How do we adjust the depreciation? So let's do this question. Vanuja Bandara prospers in his computer software business, and before long, he purchases a car for himself, and later he purchased another for his chief assistant, Bigun Karunaratne. Relevant data is as follows. Date of purchase, cost, estimated life, estimated residual value. So there are two cars, Vanuja Bandara's car and Bigun Karunaratne's car. Purchase date 1st of June 2006, 1st of June 2007. Estimated life 3 years. Residual value is given. The straight line method is used for the depreciation. Prepare the motor vehicle account and motor vehicle depreciation account for the years to 28 February 2007 and 2008. You should allow for the past year's use of a car in computing the annual charge for depreciation. Calculate the carrying value of motor vehicle as at 28th February 2008. So in this question, year end is 28th February. But just for us to understand the duration, the timing, the importance of timing. Okay, let's do this. Okay. Let's calculate the depreciation. Calculation of depreciation. 2006, for the year 2006. Right. See the financial year. Look at the question and check for the financial year. I'll draw the timeline. Okay. So this is a financial timeline. Yeah, 2000. Either you can take 2006 or 16. It's okay. It's X. No. First financial year is starting from 1st of March 2006 28 February 2007. Then the next year is up to 28 February 2008. So this is the financial year. First vehicle purchased 1st of June, March, April, May, June, somewhere here. The second vehicle purchased 1st of June 2017. Now let's calculate depreciation. In year 2006, 6 and 7. 2000, let's say 2006, 7. Financial year. 2006-7 financial year, we have only one car. Car 1. Only car 1 is available during this year. Second car was purchased in 1st of July 2007. Okay. So we have only one car in financial year 6-7. You can calculate the depreciation for that. Cost minus residual value. Cost is 202 million. Residual value is 200,000. So cost minus residual value divided by useful life is 3 years. Right? Then how many months? You need to check for how many months we need to depreciate. 1st of June, July, August, September, October, November, December, January. Feb. The financial year end is 28 February. So there are 9 months starting from March, April, May, June, July, August, September, October, November, December, Jan, Feb. Right. So this is from 1st of June. June, Right. Then 9 months depreciation. Answer is 450. Answer is 450. Then for year 2007-8, financial year 7-8. So in financial year 7-8, there are two vehicles. There are two vehicles, car 1 and car 2. Okay. So first car was purchased in 1st of June 2006. So that depreciation for that car will be 2007, 2008, both years we have to depreciate. First year 9 months, and second year we have to depreciate for the entire 12 months. Entire 12 months. Right. So how much is the depreciation? You can calculate. Then the second car, car 2, that is also for 9 months you have to depreciate. Cost is 800 minus residual value is 200, divide by 3, 9 months. Second year depreciation for car 1 is 600, car 2 is 150. Right. Right. Now we need to prepare the motor vehicle account and accumulated depreciation account. Right. Let's start with first year, year 1. There is no opening balance. There is no opening balance for both accounts. Okay, so let's prepare the ledger accounts. Motor vehicles, motor vehicle account in 2006, 1st of June, we purchased the motor vehicle, right? So this is the account for 2006, 2006-7. Then end of the year, we need to do the depreciation. So we have already calculated depreciation. It's 450. Then the depreciation will be credited to depreciation provision for depreciation account. Provision for depreciation account 450. And that 450 we have to take under income statement. Let me show the income statement as well. Okay. Draw the income statement and statement of financial position for both the years. Right, I'll take the balances. Depreciation for the year is 450. So we know the calculation. We calculated from here. 50. Then we take closing balances. Closing balance here it's 2000 and opening balance for next year 1st of March 2007 is 2000. So next year beginning balance of the motor vehicle is 2000 and accumulated depreciation balance carried down 450, balance brought forward 450. That's the closing balance. Cost is 2000. Accumulation is 450. Book value is 1550. Then the second year, 2007 and 8. This is 6 and 7. This is 7 and 8. Depreciation is 600 plus 150, total 750. 750 depreciation. Total 750 depreciation. And purchase during the year 800. Purchase during 800. Closing balance is 2800. Next year balance is 2800. There is a question why accumulated depreciation is a credit balance here. Double entry for the depreciation is depreciation account debit, that is your income statement. This is the income statement. Depreciation account debit, accumulated depreciation account means here it's credit. Here we have credit. This is a asset deduction. We have to show this balance in the statement of financial position. It's 450. This is 2,800 in your cost. Cost is 2,800. Depreciation expense is 750. Now the total depreciation is 1,200. Here, what you need to understand is the preparation. How do we prepare the financial statement? 1,200 is the closing balance. Here, 2,800 is the closing balance. This is minus 1,200. $1,600. So this is how we prepare motor vehicle account, accumulated depreciation account, and the draft financial statements. Now let's move on to the next part. Is it clear for everyone? Preparation of ledger accounts and accumulated depreciation. There is a question, why is accumulated depreciation opening balance a credit? Isn't it an expense? Depreciation is expense, that is debit. Accumulated depreciation is a credit end. It's a provision account. Provision for depreciation account. It's a credit balance. Right. Next is we did depreciation. Now, third point is revaluation. Okay, I'll give 2 minutes for you all to complete this. After that, let me explain revaluation. Revaluation is also important. You know that because in partnership and all, revaluation adjustment is like compulsory adjustment. Revaluation. Okay, let's move. Revaluation. Example. Revaluation of non-current asset. Right. So what is mean by revaluation? Revaluation means when we purchase an asset after some period, due to some reason, we have to revalue the asset. Right? In 2010, we are purchasing a land for 10 million. Right? After 10 years or 15 years, we need to revalue the asset. And because the asset values might be changed. So therefore, we need to revalue the asset. So how does that affect the accounts? That is what we are going to learn. How does the revaluation affect our financial statements? Example. When Frank Amarasinghe commenced trading as a car hire dealer on 1st of January 2001, he purchased business premises at a cost of 50 million. 1st of January 2001, he purchased a business premises for 50 million. For the purpose of accounting for depreciation, he decided the following. Land part of the was worth 20 million. This would not be depreciated. So there is a land, they are not depreciating. 20 million land. If 20 million is land, total 50 million means 30 million is building. The building part of the business premises was worth the remaining as 30 million. This would be depreciated by straight line method to a nil residual value over 30 years. No residual value, but they are depreciating for 30 years. So what is the annual depreciation for the building? Annual depreciation is 1,000,000. Okay. After 5 years of trading, on 1st of January 2006, 1st January 2001 purchased, 1st January 2006, they are changing. Frank decided that his business premises are now worth 150 million divided into land is 75 million, building is also 75 million. Earlier the land was 20 million. Now it's 75 million. Earlier the building was 30 million. After depreciating for 5 years, now it's 75 million. He estimates that the building stall has a further 25 years of useful life remaining. Building has another 25 years. Calculate the annual charge for depreciation in each of the 30 years of its life and the statement of financial position value of the land and building as at the end of each year. So that's the question. Read it again and try to understand and see how we can do this. Right. Did you all get any idea how to do this? First, I'll show you how to calculate annual depreciation. Annual depreciation of a building is land we don't depreciate, okay? Only the building we should depreciate. Can you all calculate the depreciation of the building for first 5 years and next 25 years. That means before revaluation and after revaluation. Depreciation of the building before revaluation and after revaluation. Can you all calculate this? I'll give some time. Take about 4 minutes for this calculation. Okay, so let's calculate the revaluation before and after. Before time period is from 1st of January 2001 to 31st December 2005. There's 5 years. And after 1st of January 2006 to 31st December 2030, 25 years. 5 years and 25 years. Okay. So let me take this. Yes. 5 years. And 25 years. 5 years and 25 years. Fine. Cost minus residual value divided by useful lifetime. So cost is 30,000. Residual value is 0. No residual value. Divide by useful lifetime is 30 years. 30 years. Okay. Then depreciation is 1000 per month. So first 5 years, depreciation is 1000 rupee per month. I hope you have understood that part. After the revaluation, the building value is 75,000 and no residual value after revaluation. Annum means year, per year. Annum. Then remaining useful lifetime is 25 years. At 25 years. So after the revaluation, the depreciation per annum is 3,000. Per annum is 3,000. Okay. So we can find out the depreciation. First 5 years, 1,000 per annum. Next 25 years, 3,000 per annum. So this is the most important part. Calculating the depreciation for first 5 years and next 25 years. Any doubts on this? Okay. Now, I want you all to calculate the revaluation profit or loss. Calculate the revaluation profit. So actually there is a profit. Can you all find out how much is the revaluation profit for this? As at 1st of January 2006. Revaluation profit. So we have two assets, land and building. We need to find the book value as at 1st of January 2006. Okay, I'll give 2 minutes for you all to find out the revaluation profit or loss. How do you find the profit or loss? You take the book value and the revalued amount, then you get the revaluation profit. Book value 1st Jan 2006. Revalued amount, answer is revaluation profit. Okay, find this answer. Okay, land value is 20,000. It didn't change because we don't depreciate land, so land value is 20,000 and revalued amount is 75,000. Therefore, profit is 55,000. Profit is 55,000. Okay. Then building up to 1st of January, we need to find out the depreciation and the book value. Okay, let me calculate the book value for the building. How do you calculate? Building cost was 30,000 minus 5 years depreciation is 5,000. So 25,000 is the building. 25,000 is the building book value. 25,000. I am saying for 5 years because book, we need to find out book value for 1st of January 2006. This was purchased on 1st of January 2001. So there is 5 years depreciation. That is why we calculated depreciation for 5 years. Because the revaluation was done after 5 years. And this is 75,000. 75 minus 25 is 50,000. 50,000 and total is 105,000. Is the total revaluation profit. Total revaluation profit 105. This is what you need to understand in revaluation. Next, we will do disposal. Okay, so let's do the disposal part. Disposal of PPE. Disposal means either we sell or exchange or we transfer. Okay, so let's start. A business purchased a non-current asset on 1st of January 2001 for 25 million. It had an estimated life of 6 years and an estimated residual value of 7 million. The asset was eventually sold after 3 years on 1st of January 2004 to another trader who paid 17,500 for it. 17,500,000. What was the profit or loss on disposal? Assuming that the business uses the straight line method for depreciation. Okay. So let's calculate the disposal profit. So in disposal, there are 4 important steps, right? Any disposal question, you follow these steps, 4 steps, then it's easy, right? Step 1. Step 1 is you take the cost of the asset. What is the cost? Now the cost of this asset is 25 million. 1st of January 2001, purchase for 25 million. So that is the cost. So we take the cost 25 million. 1st of January 2001. Okay. Then depreciation. 1st of January 2001, and it was sold after 3 years on 1st of January 2004. So the second step is we need to find out the total depreciation for 3 years, right? That means accumulated depreciation from the purchase date to the disposal date. Purchase date is 1st of January 2001. Disposal date is 31st December 2003 or 1st of January 2004. State 1st of January 2000. Same. 1st of January 2004. How much is the depreciation? Tell me. I want you all to answer. 3 years depreciation. There is no residual value. Annually, yeah, estimated life of 6 years. Residual value is 7 million. So 25 minus 7 is 18. 18 over 6 is 3000. 3000 into 3. 3000 into 3 years. 3000 into 3 years. 3000 into 3 years. Total 9000. 9000. Okay. So book value. Book value. So the carrying amount after 3 years, the carrying amount is 16,000. After 3 years, the carrying amount is 16,000. Right? Then the third step. Step 1, cost. Step 2, accumulated depreciation. Third step, the sales proceeds from the disposal. We are getting on 1st of January 2004, we are getting 17,500. Third step. Why did you multiply by 3 years? 3 years because there are 3 years, 1st of January 2001 to 2004, 3 years. 3000 is annual depreciation. How do you find depreciation? Cost minus residual value divided by useful life. Cost is 25. Residual value is 7,000. Useful life is 6 years. So 18,000 divided by 6, 3,000 annual depreciation per annum. Then you multiply this by 3 years. So you get 3 years depreciation. Okay, good. Next. The final step, calculate the profit on the disposal. How much is the profit? 16,000 worth of asset we are selling at 17,500. 16,000 worth of asset we are selling at 17,500. That means we are making a profit of 1.5 million. So disposal profit is 1,500. Annual depreciation I'll show you. Profit on disposal is 1,500. Is it clear? Because the disposal is the part very most of the students get stuck in the exam paper, disposal part, and it is the area where you will get confused even in company final accounts and cash flow statements and all. This is the part where the students get confused. Did you understand? If you sell less than the carrying amount, then it's a loss. Let's say your carrying amount is 16,000, you are selling at 15,000. Then you will have 1,000 loss. So I'll show this in the ledger accounts in next question. The next question, I'll show this in the ledger account. Okay. Right. Let's do next example, which is preparing the ledger accounts. Let's prepare the ledger accounts. Disposal of PPE, preparing ledger accounts. Disposal of assets, ledger accounts. A business has 110 million worth of machinery at cost. Its policy is to make an allowance for depreciation at 20% per annum on straight line. The accumulated allowance for depreciation now stands at 70 million. 70 million. The business sells for 19 million a machine which it purchased exactly 2 years ago for 30 million. Show the relevant ledger entries. Right. A business has 110 million worth of machinery at cost. 20% depreciation rate. Accumulated depreciation was 70 million, and they are selling 19 million worth of machine for 30 million after 2 years. Okay, so what we need is the ledger account. Draw 3 ledger accounts: machinery account, accumulated depreciation account, and the disposal account. Draw the 3 ledger accounts. And can you all do the 4 steps and find out the disposal profit? Find out the disposal profit. I didn't prepare the depreciation account because that we show the depreciation here and it directly goes to the income statement. Okay. How much is the disposal profit? The cost is 30,000. Accumulated depreciation, we need to find out for 2 years. $30,000 into 20% into 2 years. Accumulated depreciation. So it's 12,000. Then the book value is 18,000. Book value is 18,000. Cost minus accumulated depreciation. Then the sales proceeds 19,000. We are selling for 19,000. Profit is only 1,000. Right? Out of entire 110 million, there is one machine which costs 30 million. And that was sold for 19 million after 2 years. That is what I was explaining. Total was 100. Okay, now I will explain that part from the ledger. Then you will understand. We didn't sell all the machines. Now at the beginning, there was 110,000 machine, right? Total 110 million. I'm doing in thousands. Okay. It's 1,000. At the beginning, the value of the total machinery was 110 million, and the value was accumulated depreciation was 70,000. Those are opening balances. Those two opening balances. Out of this, we sold one machine. Okay. Now I will explain the double entries for the disposal. These 4 steps, there are double entries. Double entries for the 4 steps. Number 1, we need to transfer the cost. Double entry for this. $30,000. That is machinery account credit, disposal account debit. That's the double entry. This cost should be transferred from the machinery account to the disposal account. Machinery account credit 30,000. Disposal account debit 30,000. That's the double entry. 30,000 double entry. Second one, accumulated depreciation 12,000. Double entry for accumulated depreciation is accumulated depreciation account debit, disposal account credit. Double entry. Okay. So 12,000 we debit here and 12,000 credit disposal. These 3. Double entry for accumulated depreciation of the disposed vehicle, disposed machinery. Debit, credit, debit, credit. Third step, sales proceeds. That will be debited cash and credited to the disposal account. Cash. This is, give the numbers, number 1. This is number 2. This is number 3. Disposal account credit, cash account debit. And if you balance this, you will get the profit. Uh, 31,000 and profit, which will be transferred to the profit and loss account. P&L. Right. Then one more thing you need to do after this. You need to calculate a remaining depreciation, the total depreciation for the current year. That's the fifth step. So, total depreciation for the total depreciation for the current year. Right. Now current year total depreciation. So current year we need to take the remaining machineries. Remaining machineries, it was 80,000, right? 110 minus 30. So remaining machineries 80,000. We assume that the disposal was done at the beginning. So remaining machines 80,000. 80,000 into 20%. How much? Current year depreciation. 18 to 2, 16. 16,000. So that goes to the accumulated depreciation account credit side. 16,000. P&L. Depreciation. So in the statement of financial position, the machinery account balance is 80,000. Accumulated depreciation balance is 74,000. Right. So this is how we do the disposal part. Okay. So there is one more last question. from the disposal, I want you all to do it as a homework. Okay? This question I want you all to do as a homework. I'll share all the notes in our WhatsApp group. Okay. Up to now, do you all have any doubts?